Good day, ladies and gentlemen. Welcome to today's lecture where the topic is revenue recognition. Why have we spent so much time on revenue? To some degree, we've been beating this up pretty good over the past few weeks. So the question is, again, why am I doing that? Revenue is the essence of everything else. Everything derives from the revenue. It's the foundation of a firm's business model. The stronger the foundation, the stronger the business, and we can understand better the quality of the financial statements and put more reliance on them if that is what we're seeing. We need certain information to do that. So far, we've looked at three basic areas. There's three basic areas for revenue. One, our sales driver, volume and rate. Disclosure, how useful is the information? And then the actual, we looked at already. One, the business model. What the company does, both in volume and drivers. We've gone into that. Everybody knows their business, other business. And hopefully by now you see how important that is. On the disclosure side, your presentations have really been helpful and useful, especially SEC presses for revenue clarity. And I've attached those for your consideration. The next step is to look at the accounting beyond all of this. What is the accounting that's there? Keeping in mind that ASCS requires more comprehensive and detailed disaggregated revenue report, which helps the users determine the nature, the amount, the timing, and uncertainty of both revenue and cash flows. But to get that to that point of disclosure, we need to understand the accounting. So we're going to dig a little bit deeper here, and let's keep going. What's the basic principle of revenue recognition? It's pretty easy. You recognize income for goods and services provided to customers at an amount expected to be received. Okay? Very simple. Recognizes revenue for goods and service provided to customers at an expected amount. Now, this at times requires estimate and choices. So understanding these helps us understand the quality of the financial statement. But now we get into some of the detail. When should revenue be recognized? Order can be, when the order can be product, when the order, revenue recognition. Let's start with some very simple questions of when should revenue be recognized. And when I use the word order, I can also mean product or service. It doesn't matter. Do you recognize it when the order is placed? When the order is shipped? When the customer receives the order? When the customer pays for the order? So these are some basic questions that we ask. In a much more simpler time, we didn't have complexities, but we do today. And some of these are, what if customers can return unwanted or unused products? What about discounts for large orders? What if the sale is paid for over time? So if it's paid for over time, is there an interest component? What if the payment is upfront and the service is provided over time? What if the product price includes a product and a service? So when you think about this for a second, you may pay a fixed amount up front and you may get, for example, a piece of software, but you also get 2 years of support. You don't want to necessarily recognize that revenue up front because the costs aren't going to be incurred until a prior period. We're always trying to match revenue and expenses. What if the sale is other than in US dollars? So there's a lot of things to consider there. When we look at IFRS is actually much stricter than US GAAP had been. And when we look at it, they say revenue should be recognized under IFRS when the entity has transferred to the buyer the significant risks and reward of ownership. Does the firm relinquish all of its rights to that? The entity has no continuing managerial involvement and no effective control over the cost of goods sold. Once they lose that control, that they can do nothing with it, That's the point that it's a point in time of when the sale can be recognized. The amount of revenue can be measured reliably. Okay, it's probable that economic benefits with the transaction will flow to the entity. They're going to get paid. Costs incurred with respect to that transaction can be measured reliably, whether they're paid today or tomorrow. That's the accounts payable cycle. But can those costs be measured? So that's what IFRS says. Historically, U.S. GAAP said that revenue should be recognized when it is realized, realizable, or earned. U.S. SEC provides guidance on how to apply the accounting principle. And they list 4 very specific things as to when revenue is realized, realizable, or earned. And you're going to see that there's a difference between that and IFRS. There's evidence of an arrangement between buyer and seller. The product has been delivered or the service has been rendered. The price is determined or determinable, and the seller is reasonably sure of collecting money. Now, there's some overlap here between the two of them. But in the simplest situations of business in America the way it was, it works just fine using the above. When we look at retail sales, you go into Target, you buy something, it's very clear. Every one of these is clear. However, that's not always the case as business has become more complex, and this is what led us to ASC 606. The intent is to better manage revenue with ASC 606 really has 5 key steps. Now, you've seen these when you have looked at your company. First one is identify the contract with the customer, identify the separate performance obligations, determine the transaction price, allocate, and then decide when to recognize. So these are at a very high level. Let's keep digging down. Now, in this one, let's just break it down, is identify the contract. In that area, we look at the legal rights of the seller and customer are established. Then we look at the performance obligation. Is it single or is it multiple? This is where it starts to break things down. Single is we go to Target, we buy something, Wegmans, it doesn't matter. Multiple goes over a period of time. The performance of the product or service is over a period of time. And as we become more of a service-based economy, this becomes more and more. So the third step, determine the transaction price, is going to depend on the single or if it's multiple. If it's single, the amount seller is entitled to receive from customer. Same thing on the multiple, but we start to break it down once we know the price. This is where it breaks into 2 different components. Allocate the transaction price. No allocation required if it's a single obligation transactions. If it's multiple, we have to allocate a portion of each performance obligation. Then we have to determine from a revenue recognition when that performance obligation is satisfied. So we recognize revenue when the performance obligation is satisfied. First we identify, then we identify what is the obligation, determine the transaction price, allocate the transaction price to the different component of its multiple, and then decide when are we going to, when is this performance obligation done so that we can recognize the revenue. Is it a point in time? Over a point in time. When we get to multiple, we're doing the same thing, expressing it on. POs being performance obligations. Now, let's keep digging a little bit deeper. I think this is really, if there's one thing here, you should have a knowledge of these 5 steps, but being able to apply them like this becomes a key thing. First thing is to identify the contract with the customer. And what I've done is I found a number of pieces to sort of put it together so we're not dealing with tons of stuff, but just enough to get by and understand what we need to. The following criteria are used for a contract to be identified. Must be approved by all parties to the contract. Everybody has to approve it. Each party's rights must be identifiable. So when you read the contract, if it's a very open-ended one, it doesn't meet that, but it's very specific. Payment terms must be identifiable. When are they? And overall, the contract must have commercial substance. And it's probable that a vendor will collect the consideration to which it's entitled. So that's identifying the customer. Step 2, identify the performance obligation in the contract. A little bit more. What we're trying to do is determine whether the nature of the promise within the context of the contract is to transfer each of these goods or services individually, or are they combined in a package? Okay? Because it's necessary to determine which goods or services represent separate performance obligation, POs, to identify the units of account for purposes determining when to recognize that income. Now, how do we do that? Key considerations. If goods and services are distinct, distinct means, are they sold separately? Does the good or service have value to a customer alone? Okay? Is it value alone? Can I buy just the service, goods and services? Not only is it sold separately, but can I use it that way? When should goods and services be bundled? Well, goods and services are interrelated, and seller provides significant service of integrating goods and services on the customer's behalf. A lot of this is in the area of software. Seller is engaged by buyer to significantly modify or customize the goods or service for the buyer's use. Okay, we're not just giving you a standard package. The seller and the buyer and the seller are integrated for purposes of making it work for the customer. The entity is, this is determination of that separate performance obligations. The entity is providing a significant service of integrating the goods and services into the combined item for which the customer has contracted. Again, this is in software. Okay, goods and services are not distinct as the criteria. They can't benefit from something like a CRM system on a standalone basis. Therefore, the entity would account for the license and consulting services as one performance obligation, thus coming back over a period of time. Next thing we're going to look at is determining the transaction price, the amount of consideration that the seller expects to be entitled to. It doesn't include customer risk, and it's affected by variable compensation. So now, one of the things is sometimes in this is the variable compensation, is that the customer may have a consideration that's given to them, consideration payable. This is different. So we have the transaction price, here's the price, but there's variables that come into it. And these variables could include coupons, vouchers, performance bonuses, etc. Consideration payable to the customer should be treated as a reduction of the transaction price unless there's a valid exchange, distinct service or good. So a lot of times we will see the transaction price may be the list price, but there's also concessions that may go in there. A volume discount, a coupon, these type of things. So we need to be wary of that. Once we get the transaction price, how do we allocate it? We allocate it to all separate performance obligation in proportion to the standalone selling price of the good or service. So when we're going to look at, there's the actual, say, software, and then there's the support side of that, we're going to try to allocate those prices. Allocation of a discount, okay, we're going to reduce it by that. We're going to have, if there's variable compensation consideration coming in, that has to be adjusted. And that all results in changes in the transaction price. We have to estimate this standalone selling price. And sometimes when it's bundled, it can be a little more difficult. There's three basic ways. A market assessment, expected cost plus margin. It would seem that the number of assumptions around expected cost margin would be a little bit more accurate in my opinion, and then a residual approach, which is much more limited. Once we do that, as each performance obligation is satisfied, we need to determine when to recognize it. And it should be recognized when satisfaction of a performance obligation by transferring goods or service to the customer. A good or service is considered transferred when the customer obtains control. And they can be satisfied over time or at a point in time. The number of indicators that you can look at to determine when control is transferred. The entity itself has a present right to payment for the asset, not coming in over time. The customer has legal title to the asset. It is not a license. The customer has physical possession of the asset, tangible or intangible. The customer has the risk and rewards of ownership of that asset. And the entity has evidence of the consumer's acceptance of this. So this is how the final step. What are the next steps? Well, watch the background video on ASC 606. Focus on the importance of the why of it and challenges in implementing it. There's going to be 2 questions on the next quiz based on this video. Okay? Smart people will take note. Review the background information from our student presentations and the AICPA course materials, both which are posted in this module. And if you have any questions, please let me know. And I think we've done a job on beating up revenue, and other than figuring out how to forecast it, we're going to be done with that. So if you have any questions, do let me know.